Are we ready?
Okay, you may now begin.
Thank you. Good morning, everyone. Today is May 10th of 2022 at 10 a.m. And this is a meeting of the Budget, Finance, and Audit Committee of the Housing Opportunity Commission of Montgomery County. This morning, I have with me for this meeting two commissioners, Rick Nelson, Commissioner Pro Tem and Chair of the Budget Committee, and Jeffrey Merkowitz, who is also a commissioner member of the Budget Committee. Commissioner Nelson has asked me to run the meeting for him today, as he may need to step out at some point. So we have him here now, and we're happy to have him here. We will be discussing a couple of additional sections of the budget, which will go before the full commission in June for approval. And I, at this point, would like to invite Tim Gertzinger to give us an overview of them. Oh, first we need to discuss the minutes. We have minutes from a prior meeting of April 26th, 2022. And is there anyone who would like to move approval of the April 26th minutes?
So moved.
Is there a second?
Second.
Thank you. There's a motion and a second to approve the Budget, Finance, and Audit Committee minutes of April 26th, 2022. All those in favor say aye.
Aye.
Aye. The motion is approved unanimously. With that, we will turn to our reports from the Budget and Finance staff. Tim, would you like to introduce what we'll be talking about?
Thank you, Commissioner Kelleher. For the record, my name is Tim Getzinger. I am the Chief Development Funds Officer and Acting CFO for HOC. And welcome commissioners, staff, and the millions in the viewing public. On April 26th, Tomi Adebo and Terry Fowler presented the review of the FY23 recommended budget for the general fund and public fund, and introduced changes to the HCVP program, which resulted in a surplus of $35,000 based on increased fees paid from the HCVP to the general fund for overhead expenses. In today's BF&A meeting, Tomi and Terry will review the FY23 recommended budget for the Opportunity Housing, Mortgage Finance, and Real Estate Development funds and inform the committee of any changes before we present the budget for adoption. All right, I believe Tomi is up first. Tomi, you are on.
Thank you, Tim. If we can begin by moving to page 14 of the packet. Thank you. This chart represents the FY23 agency recommended operating budget as presented at the April 6, 2022 commission meeting. At that time, we presented a budget of $306.9 million that was balanced with a draw of $1.26 million from the general fund operating reserve account. If we move to page 15, we can see that the revised budget now shows a surplus of approximately $35,000 based on increased fees paid to the Housing Choice Voucher program to the general fund for overhead expenses. On page 16, we can see that the FY23 recommended budget included income of $102.522 million, the majority of which is based on rental income, net of concessions and vacancies, coupled with income from retail space, laundry and parking income, and various fees. Refinements have been made to the tenant income on the metropolitan properties based on increased vacancies anticipated during renovation of approximately $100,000. The transfer between funds for State Rental Partnership and Dale Drive have increased by approximately $39,000 to reflect the increased draws from the existing property cash necessary to cover the higher fees charged to the properties based on the update to the indirect cost model, which we will see on slide 8. The net impact of the changes is a reduction of $61,000, resulting in income of $102.461 million. Moving on to page 17. Thank you. This slide reflects the distributions of the source of funds received to support the Opportunity Housing Funds. As you can see, tenant rent makes up $98.34 million, or 95.8% of the fund's revenues. The remaining also includes transfers between funds of $1.44 million, or 1.4%, which is the county funding for rental license fees, utilities, and HOA fees at the properties. In addition, shortfalls at a few properties are being covered by transfers from existing cash or the GFOR. Non-dwelling income of $1.02 million, or 1%, which includes retail space. And we have laundry and parking income totaling $1.11 million, or 1.09%, just to name the larger pieces. If we move on to page 18, we can see that the FY23 recommended budget included expenses of $99.541 million. The following revisions have been made to the recommended budget. Operating expense fees has increased by approximately $941,000 based on the update to the indirect cost model. Maintenance expenses at Cider Mills has increased $207,000 based on identified plumbing needs at the property. Expenses for the metropolitan properties changed due to anticipated impacts from the impending renovation, coupled with the restriction of cash flow for the necessary repairs to the green roof. This includes debt service at the properties, which was reduced based on the removal of the debt service payments of $944,000 that will be covered by the renovation budget during renovation. Also, the replacement reserve contributions was removed during renovation, which is approximately $46,000. And the restricted cash flow was increased $895,000 to adjust for the anticipated air rights payments to the county and restrict additional cash for the green roof repair. Refinements have also been made to debt service, which increased by $316,000 on the inclusion of the amortizing loan. As a result, debt service reserve contribution, which is the difference between a fully amortizing loan at 6.5% and the current debt structure, were decreased by $316,000 based on the increased actual payments. As a result, the increased fees charged to the agency overhead based on the updated indirect cost model, we've adjusted operating reserve contributions on the foreclosed home, which decreased $4,000 approximately. We've restricted cash flow, a decrease of $298,000, and the development corp fee expenses for the properties decreased by $330,000. Therefore, the total expense have increased by $421,000 to $99.962 million. If we look at page 19, we can see that the slide reflects the distribution of the use of funds in the Opportunity Housing Fund. The chart shows a breakout of operating and non-operating expense. Unlike previous funds we've presented, you can see that the pie on the left you can see from the pie on the left that expenses for the properties are nearly equally divided between operating expenses to support the operations of the property of 51.8% and non-operating of 48.2%. The largest non-operating category is debt service of $34.34 million, or 34.35%, which equates to almost 3/4 of the non-operating expenses, followed by contribution reserves, which accounts for 5.21 million or 5.22%. Finally, the distribution of cash flow to the development corporation fees of 5.41 million or 5.41%, and the restricted cash of 3.22 million or 3.22%. If we move on to page 20, this chart reflects the 5-year history of total property cash flow, which is broken into 3 categories: development corporation fees, unrestricted cash flow, and restricted cash flow. As you can see from this chart, total projected cash flow has increased by approximately $940,000 for FY23 when compared to FY22's amended budget. This is largely due to the previously mentioned lower debt service payment, coupled with lower projected bad debt expense for FY23 that is particularly offset by the increased fees for overhead, coupled with the removal of the properties that were included in the FY22 amended budget for 4 months and converted to tax credit properties. Looking at slide 21, thank you. This chart represents the FY23 agency revised operating budget, summarizing the changes discussed today to the Opportunity Housing, shaded in peach, as well as changes discussed at the April 26, 2022 meeting related to the public fund, shaded in green. As a reminder, the FY23 recommended budget includes a contribution of $1.26 million from the general fund operating reserve. The net impact of the changes introduced in this presentation results in a net increase of $611,000 in income to the general fund based on an update to the indirect cost model, which increased fee income by $941,000, offset by lower development corporation fee income from the properties of $330,000. The net impact of the changes to the income and expense to the Opportunity Housing Fund is a decrease of $481,000 to the unrestricted cash flow. The net impact of these changes, combined with the increased fees paid from the Housing Choice Voucher to the general fund for overhead expenses of $35,000, results in a positive balance of $165,000, which will be discussed at the end of today's meeting. I'll be happy to answer any questions you may have at this time.
Are there any questions from the commissioners for Tommy? Jeffrey, is this going to be a first that you have no questions?
Perhaps.
Okay. Excellent presentation, Tommy. Thank you very much.
Thank you.
And with that, I believe we have one additional item to go through on today's agenda related to the fiscal year 2023 mortgage finance and real estate development budgets.
Yes, thank you, Commissioner Kelleher. Good morning, commissioners, staff, and the viewing public. If we could move to page 27 of the packet. As Tommy mentioned previously, the recommended budget that was presented included $306.9 million with a projected draw of $1.26 million from the general fund operating reserve. Unlike the previous presentations, which focused on individual funds, today's meeting will involve discussions related to all 5 funds: the general fund, the multifamily and single family bond funds, the OHRF that is a part of the Opportunity Housing Fund, and the county grant section of the public fund. We can move on to page 28, please. Could I ask it, and maybe it's just me, it looks like the full slides are not visible. Thank you. This slide was the final slide in Tommy's presentation, showing that we now have a positive balance of $165,000, which will be discussed at the end of this presentation. If we look at page 29 of the packet, this is showing the 5-year detail of the mortgage finance division. And you will notice that the non-operating income and expenses are noted in light blue. The mortgage finance division generates loan management and commitment fees on the transactions that are financed by HOC and monitored for loan and regulatory compliance. Loan management fees for FY23 have increased $55,000 from the recommended budget. Commitment fees, which are split 40% unrestricted to support agency operations and 60% restricted to the OHRF for future capital investments, have decreased $629,000 from the recommended budget, of which approximately $252,000 is unrestricted and $377,000 is restricted. And this income supplements the unrestricted cash from our properties to support agency operations. In addition, we have a very small change to the FHA risk sharing. This represents the mortgage insurance premiums received from the properties financed with the support of the program and then restricted to the FHA risk share reserve. That has decreased $150, which is a decrease to the income as well as a restriction to the reserve. If we move to page 30 of the packet, this graph shows in pie form the breakout of the FY23 projected revenue that was previously discussed. Commitment fees make up approximately $4.8 million or 39.53% of the revenue in mortgage finance, with $2.9 million or 23.72% restricted to the OHRF and $1.9 million or 15.81% going to the general fund to support agency operation. Bond draws account for $3.5 million or 29.32% of the revenue to support the administrative costs of both the multi and single family bond programs. FHA risk sharing represents $1.1 million or 8.9%. The county closing cost grant equates to $195,000 or 1.61%. And finally, the loan management fees represent $2.5 million or 20.64%. If we could move on to slide 31. This graph is showing a pie breakout of the 2023 projected expenses that were previously discussed. As you can see, personnel makes up approximately 50% of the expenditures in mortgage finance, with the balance coming from the management fees paid to the agency of $1.145 million or 22.74%. And the next largest piece is the FHA risk sharing, which is the restriction of the income received to the FHA risk share reserve, which accounts for about 21.3% of the expenses. We can move now to slide 32 of the packet. This slide shows the 5-year detail of the real estate development division. Again, non-operating income and expense are shown in light blue. Development fees, similar to the commitment fees generated by mortgage finance, are also split, with 40% being unrestricted to support agency operations and 60% restricted to the OHRF for future capital investments. This income has increased approximately $113,000 from the recommended budget, of which approximately $45,000 is unrestricted and $68,000 is restricted. We can now move to page 33 of the packet. The changes in this packet are reflected on this slide. The net impact of the changes to income and expense results in a net decrease of $151,000 in fee income to the general fund and a net decrease of fee income to the OHRF of $310,000. The change in the OHRF will result in less income being restricted to the fund. The change in the general fund impacts our bottom line, resulting in a positive balance at this point of approximately $14,000. Since the recommended budget was balanced with a draw from the general fund operating reserve account of approximately $1.26 million, staff recommends that this draw be reduced by the surplus of $14,000 introduced thus far. It is worth noting that staff does anticipate that there may be small changes between now and June as a result of updates to our complement and final grant funding. And we will present a reconciliation when the FY23 budget is presented to the Commission for approval at the June 8, 2022 meeting. And I would be happy to address any questions you may have concerning the packet.
Any questions from Commissioner Merkowitz?
No, both Terry and Tommy did an excellent job and actually anticipated some of my questions. So I
Yes.
don't have any additional questions.
I have to say, these presentations have become much more helpful to us as commissioners over the past few years. It's much clearer what some of the programmatic changes behind the numbers are and why you're showing changes where you're showing changes. So thank you for the extra work that I'm sure it takes to make these presentations so helpful.
Thank you.
I don't see any motions here today. Is there a need for a motion from this, or are we simply going to move ahead for these to also be presented to the full commission?
Yes, what we will present in June is the final proposed budget along with a detailed reconciliation of the changes that we've introduced thus far and any updates that will occur during our final balancing over the next couple of weeks.
Sure. Yes, it looks as if you have worked very hard to account for all of the various funds, and the nets that you have here are relatively small given the size of the budget. So I appreciate the work that you have gone to make sure that the revenues that we do receive will be appropriately applied to the business that we are in. And thank you. With that, I will take a motion to adjourn.
So moved.
All those in favor, say aye.
Aye.
Okay, unanimously, we're adjourned. Thank you all.
Thank you. Have a good day.
See you
Thank
in
you.
a couple of weeks.